Hey, Isabel, it's all yours.
Okay, well, thanks for having me. I have um, been a guest at one of these coffee and conversations before a couple of years ago. So thank you to Arlington Neighborhood Village for welcoming me back. And at that time, the last time I was talking about legacy planning and various gifting strategies to combine tax efficiency. Um, with our desire to maybe help out our favorite charities and organizations. Talking a lot about the use of donor advised funds at that time. And I'm going to touch on that again today toward the end of my talk. But who I am an executive director of financial planning at Edelman Financial Engines. And so I'm going to really kind of focus on the financial planning topics around charitable, qualified charitable distributions. I'm not an accountant. I am not an estate attorney. So if you have very detailed questions about those things, I will refer you back to those specialists. But today I'm going to kind of dig into QCDs and then, hold your questions for the end and we can hopefully get them all answered. But like I said, I'm going to focus on a charitable giving strategy that has become more and more popular and really widely used over the last decade or so. And that's the qualified charitable distribution. Throughout the conversation today, I'm going to call that a QCD. So that's, if you hear the word QCD, I'm talking about the qualified charitable distribution. Now, the strategy is really focused on use by folks who are number one, charitably inclined, and number two, looking for tax smart strategies, and number three, who may be impacted by Medicare income related monthly adjustment amount, also going to use the term IRMA to describe income related monthly adjustment amount. So the big questions are, what is a qualified charitable distribution, QCD? Who can use one, and why we might be interested in using a QCD over other strategies. So I'll talk through kind of all of those things here initially. So what is a QCD? In 2006, the QCD was introduced as part of the Pension Protection Act. And at that time, it was introduced as something temporary, and we as advisors never really knew from one year to the next if that QCD was going to be allowed again the next year. And then in 2015, the QCD was made permanent within our tax code. So a QCD, qualified charitable distribution, is when an IRA owner over the age of 70 and a half makes a transfer of money directly from an IRA to a qualified charity. Now, this is not the same as taking money out of an IRA, paying taxes on the withdrawal, and then making a donation. In the case of a QCD, the money goes directly out of the IRA custodian to the charity or many charities that you have chosen. So instead of writing a check from your checking account and using after-tax money, or maybe having a regular monthly credit card payment to your favorite organizations, instead, you set up this charitable donation to come directly out of your IRA. Now, then your question is, why would you want to do that? It seems like more of a hassle. Why would that be possibly a better way than taking the distribution and just giving it out, or giving money from an after-tax account? Well, the key here is if you instead use the QCD, the amount that you gift out directly is excluded from your taxable income, even when it's coming from a pre-tax account. So you are not paying taxes on whatever amount you are distributing out of that pre-tax IRA, on anything that is given directly to the charity. And that can be a really big deal for people who are either maybe in a high tax bracket. If you are someone who is close to the Medicare IRMA brackets, or a higher Medicare IRMA bracket, or are worried about getting kicked into a Medicare IRMA bracket, It's also a big deal for people who are no longer itemizing their deductions. Um, Tax laws over the past few years have really significantly reduced the number of people who can itemize just because now there is a much higher standard deduction than there had been in previous years. So you may have been used to making charitable donations, taking big deductions for them because you were itemizing. You're no longer itemizing, but you're still making those charitable deductions and maybe not getting the same benefit for that. So then the question is, can you make the QCD? So who can make the QCD and when? So the number one rule is that you have to be age 70 and a half or older when that distribution is made directly to the charity. And I know that sounds kind of weird because you're thinking 70 and a half, but that's the old RMD age, and now RMD age is 72 or 73 or 75 for some. Well, for whatever reason, the QCD age was locked in at 70 and a half or older. So as long as you are 70 and a half or older, even if you're not required to take an RMD yet, you are still eligible to make a QCD after age 70 and a half. The second rule is that distribution has to come out of an IRA, a pre-tax IRA. So what kind of accounts count? What doesn't? A traditional IRA would count. An inactive SEP or simple IRA, as long as they're inactive, those should be eligible. And an inherited IRA is also eligible. What you are not eligible to make a QCD from is an employer-sponsored plan. So a 401k, a 403b, a TSP. If that money is still in the employer-sponsored plan, it cannot be made directly out to a charity as a QCD. However, you can annually roll money over from an employer-sponsored plan into an IRA and then make the QCD from that new IRA. So you can do that on an annual basis. Now, the check itself, in this case, when you're making the QCD, has to come from the custodian and be made out directly to the charity or charities that you've chosen. And I get the question all the time, well, do I do it once a year? Can I do it multiple times? Can it go to 10 different charities or one? You can make a QCD as often as you want throughout the year between January 1 and I'll say December 31st, but really it's a little bit earlier than that because it's very hard at the end of the year for custodians to deal with the number of requests that are coming in. But you can make this monthly. You can do a QCD out of your IRA once a year. It can go to one charity. It can go to 100 charities. Now, that being said, the charities that you're giving the money to have to be a qualified 501c3. They have to be US based. They must be a registered not-for-profit. And a QCD cannot go to a donor advised fund. I know I haven't talked about that yet. I will a little bit later. But if you use a donor advised fund, the QCD cannot go into that. And lastly, the maximum amount that you can give in any one year from your IRA to a charity or many charities through the QCD for 2026 is 111,000. So this number actually has been going, it started at 100 and it's been going up annually as it's indexed for inflation. So that number is 111 now, maybe more next year and the year after, et cetera. Something that is new for this year is there is also the possibility that you may choose to use some of this QCD for a one-time life income gift, and that's for something that would be created by an estate attorney as part of trust planning, like using a charitable remainder trust or a charitable gift annuity. So there are some ways that you may be able to fund something else other than directly to a charity, but those are topics that you really have to discuss with an estate attorney if you're interested in looking into that in a little bit more depth. So I mentioned earlier that a QCD for many people might be a better option than making a gift outright. So let's kind of think about let's think about why and maybe some examples of how that could work. Why a QCD may be a better tax decision for you than just making the gift outright. So, like I said earlier, most taxpayers now are using the standard deduction instead of itemizing. And that's especially true for people who may not have big mortgage interest deductions. Maybe you have a very low mortgage interest, or maybe you don't have a mortgage anymore. Maybe you're limited by the SALT cap, the state and local income caps. Or maybe you don't have big medical deductions to use, even though you may have sometimes, you don't have them consistently. So you're using most of the time a standard deduction instead of itemizing. And if you don't itemize, you may be receiving little or no tax benefit from your charitable contributions. So if you use the standard deduction, you can claim what's called the universal above the line charitable deduction of a cash only gift. This is once per year, meaning if you're making donations of clothing or books or furniture or whatever, that does not count towards this. This is only for a cash gift. It's $1,000 a year for single filers that you can deduct in this one time only, or the once per year above the line charitable deduction. 1,000 for single filers, 2,000 for a married couple if you're married filing jointly. But any cash donations that you're making above that, if you're not itemizing, you may not be eligible for getting any tax deduction or even benefit for those charitable donations that you're making. Now, also the One Big Beautiful Bill Act changed how much can be deducted even for people who are itemizing. So even if you're an itemizer, the OBBBA limits the deductibility of charitable donations to, and this is going to be a little confusing, but just it's very limited versus how it used to be, to the amount that exceeds 0.5% of your AGI. And in 2026 onward, all itemized deductions are limited to a maximum of only 35 cents on the dollar, maximum tax benefit of 35 cents on the dollar. And it used to be 37, I think. So it's a limited deductions period. So a QCD in this case can provide a tax benefit regardless of whether or not you are someone who itemizes, because the QCD is coming out of what would have been a fully taxable account, a fully taxable distribution otherwise. But in this case, if it's made directly to a charity, it is not counted as income. Now, this is also really especially important for people who are taking RMDs. So that lower income might help you to reduce taxation of your Social Security benefits, for example. I mentioned IRMA. It might keep you in a lower IRMA bracket because you're not counting that as income anymore. It may reduce your exposure to certain tax phase outs, right? We know that we are income phased out at certain levels. If our income is over a certain number, we might lose certain phase outs or certain tax deductions. Maybe lower net income, net investment income tax, and improving our eligibility for certain deductions or tax credits also. So I mentioned RMD age folks. And they are the RMD aged folks. So if you're 73 or older and you are taking RMDs, you are really the person who would benefit most from a QCD strategy if you are also charitably inclined. So typically you have, as you know, a required annual required minimum distribution from your pre-tax retirement plans, either an IRA or 401k, not from a Roth, but really from everything else that's pre-tax. And once you reach that RMD age, you have to withdraw that certain amount from your retirement account every year. That amount is based on the prior year's ending balance combined with your age. There's an IRS tax table that shows the divisor based on your date of birth. And that's what determines your RMD each year. And it's not really in your control what that number is going to be. It's how much your account fluctuates and what your age is. And if your account is going up and you're getting older every year, that RMD age or that RMD amount is going up year after year. So if you decide to use a qualified distribution for a portion of that, any amount of that RMD, that donation to charity can satisfy that RMD requirement. So, for example, well, again, and it's limited to $111,000 for this year. But let's just say, for example, that you are someone who has a $50,000 required minimum distribution this year. So that's an IRA about $1 million. And you typically gift out, let's say $10,000 to your favorite charities. If you do that without using a QCD, you take your required minimum distribution of $50,000, you take it out, you put it over in your bank account, you pay income tax on it, federal and state income tax. That increase that puts you now in a tax bracket that includes that $50,000. Again, maybe limited for other deductions you're over the cap on. It may be pushing you into IRMA, et cetera. You're only getting a $1,000 or $2,000 deduction in your taxes for that versus the $10,000 you used to get when you itemized. But if in this case you use the QCD to gift out $10,000 directly to the charity instead of writing a check to your charity, your taxable income for that RMD is now only going to be $40,000. So instead of paying tax on 50 and having 50 increase your AGI, you're only going to have 40 toward that number. Now you can still, give the other $1,000 or $2,000 out to your favorite charity to take that universal deduction. But in this case, if you use the RMD, it has the impact of decreasing your income for tax purposes by $10,000 in this example. And again, you can run those numbers any way you want up to 111,000. Now, even if your RMD in that case, in my example I just used, was 50,000, you can gift out more than that and have none of, and as long as it's going directly to a charity, that will not be taxable as income if it is a QCD. So one of the things, so all of that sounds great, but if you use a QCD, what can happen is it can actually become a little complicated when it gets to your actual tax filing. So, and some people make mistakes when they do this, especially if it's the first time and you haven't done it before. So what are some of the common mistakes that people make when they are starting a QCD or doing it for the first time, or thinking about this and not really sure how to do it, or not working with a financial planner and trying to do it on their own, for example? Number one is taking possession of the funds. You are not allowed to take possession of the funds before it goes to the charity. The money has to go directly from your IRA, be made out in a check from the custodian directly to the charity. Now, that check will have things on it that tell the charity from whom the money is coming. Oftentimes you can request that a letter be included or a memo that says, I want this to be used for XYZ purpose, or this is to go toward this particular fund, or, in legacy or in memory of an individual. So that charity knows that it's coming from you, but it's not actually coming from you. It's coming directly from your IRA custodian. Number two is I have had clients over the years try to make a QCD to an ineligible organization. So an overseas organization, or an organization that's not a public charity, or an individual, for example. So a QCD does not work that way. It has to be made to a qualified 501c3. It cannot be made also to a donor advised fund or to a private foundation. So before you initiate a QCD, my advice is always reach out to the charity to whom you're looking to make that donation. Make sure that they qualify as a 501c3. Make sure that they know it's coming. I've also had the experience with some clients where they send out 10 checks to 10 different charities, and then we find out 3 months later that 2 of the charities didn't cash the checks. It was in a pile, they didn't open it, and they didn't know it was coming. So, then we're kind of working backwards to try to figure out how to work that out, especially if it's from one tax year to the next. So make sure the charity knows it's coming, and then follow up. So you want to make sure you verify that they are a qualified charity and that they know it's coming. All you need to do to provide the information to your custodian is the name of the charity, the address, contact person, and a phone number to reach them, and then how much you want to donate and when. So another mistake, and I kind of touched on this earlier, but another mistake is waiting too late. So my advice is, if you're going to try to initiate a QCD, do that sometime between January 1st and December 1st. Waiting until later in December can be really tricky because the custodians get really overwhelmed with other requests, not only QCDs, but other, year-end things. And so I know the cutoff dates for QCD requests has been getting earlier and earlier and earlier every year. So I say, try to get your list going early, figure out the charities that you want to help and assist, provide that information to your custodian, and try to get that done before December 1st. Because you never know if it'll end up getting completed if you're waiting until really late in December. Technically speaking, an RMD has to be done before December 31st, so you should have time. It's just whether or not the custodian can actually get it done for you. Another mistake is not keeping track, right? So it is the responsibility of you as the donor to keep track of those distributions that you've made. Because when that distribution is made out of your IRA, for whatever reason right now, the IRS doesn't require the document that you receive, the 1099-R, to show that that was a QCD. I don't know why. Maybe they'll change that over the years, but it is upon you to keep a record, either an acknowledgement from the charity, a distribution record from your IRA. You can ask for that from your custodian, but it's on you to keep track of those so that you can provide those to your accountant or use it for your tax planning software when you are reporting that on your taxes. So let's see here. So yes, and you need to ensure that it's then reported correctly. So again, on you to work with your accountant to make sure that it is, they're actually showing that as a QCD, and you're not ending up paying taxes on it and not getting the benefit that you were supposed to. So as I mentioned before, there are also other ways to gift that may also benefit you, especially if you're looking for a big tax deduction in a single year. And that may be because of a windfall, a home sale, or something that's going to increase your taxes by a lot for 1 year. You may be looking for tax deduction. So a QCD can really help you in reducing your taxable income, but it's not technically a deduction. And so there are ways that even, if you are typically taking a standard deduction, that you might be able to start itemizing by making one large donation to a donor advised fund in any given year. So what's a donor advised fund? That's essentially a brokerage account that you open that is in and of itself the charity. So it's an irrevocable contribution to a charity, but it's held in an investment account where you don't have to actually gift out the money in that same year that you make the donation to that fund. And many brokerages or independent companies have these donor advised funds. We work with Schwab and Fidelity. For example, they each offer their own donor advised funds. And essentially, again, this is an account that you set up that you are managing throughout the year, and they're pretty simple and easy to set up. So it's a charitable giving account. It allows you to make a tax deductible contribution, assuming that it's enough to get you over the standard. You invest those funds for tax-free growth. So there's no taxes paid on it while that money is invested in it. The money then is gifted out to a IRS qualified public charity at whatever pace you want. So for example, you put $100,000 into a donor advised fund. You could gift out $5,000 a year in perpetuity. And maybe if the account's growing, you're ending up gifting out a lot more than $100,000 over your lifetime. And if you pass away before you've used it all up, that's a legacy that you can leave to someone else to inherit from you and gift out, continue to gift out based on whatever you've instructed them to do. Now, like I mentioned before, you can't use these two things in combination. So you can't use a QCD to fund a donor advised fund, but you can do both. You can do both side by side. So let's say you want to make a very large lifetime gift to a charity of your choice, but you're just not sure when you want to make the gift. You want to make it over time. But if you make it over time, that could really dilute the tax benefit to you, because if you're making the contribution to the donor advised fund, but you're not taking a standard, you're taking the standard versus itemized, maybe you're not getting credit for that. So instead, you want to make a very large gift all at once. That's called bunching contributions to a donor advised fund. You make all of your lifetime contributions all at once, and you get to take that deduction in that same year. And let's say that's a very large income tax year, or you're looking to significantly reduce your taxable income for that year specifically. You could use both the QCD to reduce the taxation of your RMD, and then give that money directly to charities within that year, and then also use the donor advised fund to make a big, large bunching gift of after-tax money, and then getting to deduct that. So you'd be eligible then to itemize, assuming the amount of the gift is large enough. So again, bunching is making one large contribution to a donor, and you don't have to bunch, but that's just a strategy that a lot of people use to get a very big tax deduction in 1 year, without having to actually make those donations to your charity or charities in that same year. And again, the underlying rule here is that whatever charities you're gifting to do have to be eligible 501c3. So that's kind of the crux of it. I guess I'll open the floor for questions if people have questions here on either donor advised funds or qualified charitable distributions.
All right. I think you've already answered this, but just to reiterate, a QCD cannot come out of a 401k, a 403b, or a federal TSP account.
A QCD cannot be made from a non-IRA retirement account. That's correct. But there's a workaround there. So because you are allowed to make one rollover per year, you could roll over money into an IRA in order to qualify for a QCD in that year.
And that rollover is not taxed?
A rollover in and of itself is not taxable, no.
Okay.
As long as you do it the right way. There are a whole bunch of things that have to be done correctly, but as long as you create or enact the rollover in the appropriate way, then yes, that is not a taxable event to you. It's a reportable event, but it is not taxable.
Does the custodian notify the charity of the name of the donor, or can you do an anonymous donation?
You can do it both ways. So I have clients that will want to do an anonymous donation, and there does not need to be any information on the check other than to where it's going, and they will know that it came from, for example, Schwab or Fidelity. But yes, you can make an anonymous donation, or you can request that the custodian include information as to, for example, maybe it's a particular fund that you want that money to go to, or a project or a scholarship fund or something. And I have clients all the time who will want to make a QCD and say that they want this to be in a legacy memory of someone. So all of that information can be included on the check. I have run into where we have too many words or too many letters and it doesn't fit. But in that case, we can also just include a letter that would say, here's where it needs to go.
Okay.
I'm sort of interrupting because I do not know how best to raise my hand or anything. May I ask a question? Is it a good moment?
Sure. Go for
Okay,
it.
hi. That's okay. I have been giving QCDs in various charities directly from an IRA that obviously is taxable. And I was doing it at when I was taking the required minimum distribution. I annuitized that IRA. It was an annuity. So I'm receiving annual payments that are not just, they're above the amount of the RMD. Am I allowed to consider all of those monies as QCDs?
No.
And I'm giving them to the charities as I had in the past, but I'm now taking the standard deduction. So I don't want to double count. Can you advise me if I'm doing the right thing?
Well, in that case, so no, you're not eligible to QCD that. However, you would be able to, if you are taking the standard, um, you would be, well, it depends on how much you're wanting to make out, make every year. The thing is it really does significantly reduce the amount of tax benefit you get because let's say, well, I don't know how to exactly describe this, but, because the standard is so much higher, you're missing out on whatever that amount over the, what the standard used to be and what it is now. All of that used to be considered a deduction is no longer credited. So you're only getting the credit even if you're itemizing for whatever's over the standard. So it's so much higher that it's really a reduced benefit. I think in your case, you might consider a donor advised fund in lieu of the QCD. That may be something to consider because you could make quite a larger contribution in any one year.
One last question on that one is that implies the donor advised fund is to one particular charity, not more than one. Is that
No,
correct?
actually, yeah. So that's a great point. No, a donor advised fund is you would set it up in your name. So or in the name of your family or a legacy memory. The donor advised fund in and of itself is the charity, right? So well, it's not actually technically a charity, but it is the gift to charity is when you make the contribution into the donor advised fund. Now, once the money's in the donor advised fund, it can sit there. You're under no obligation to distribute that money under any particular schedule. The expectation is that you are going to make regular contributions to charity over time. Once you've made that contribution to a donor advised fund, you can't take it back. You put the money in, you took a deduction for whatever you put in that 1 year, and then you can gift it out to any charity that you want that's a 501c3 either that same year, and you can keep doing new contributions every year and gift it all out, or you can leave the money in there to grow and gift it out more slowly. But it does not have to be the same charity every year. You don't have to, you can pick a new charity every single year. You can gift out to 100 charities from your donor advised fund per year if you want.
And I don't have to put any indication of that when I set up the fund. It would be when I decide to distribute it.
Exactly. The only thing that you need to decide when you set up the fund is the name and who your beneficiaries are going to be. Beneficiaries meaning who would take over that account for you to make decisions as to what charities receive it upon your passing.
And a beneficiary could be a trust?
Yes.
That's
actually a great question. I believe so, as long as there's a named trustee, but not 100% sure on that. I would have to double check, but I believe so.
Thank you very much.
Okay, you've talked about the custodian directly transferring the money to the charity. This person says their IRA has in the past provided a checkbook that they could write checks to make these donations. Is that still possible? And if they want to go to having the custodian do it directly, how do they do that?
Oh, that's a new one. So in the custodians that we work with have not offered us that option of having a QCD checkbook. That may be a possibility. If it's not one that I'm familiar with. None of the custodians that we work with offer a checkbook. It's always something that our clients will come to us to do. If that's an option that your custodian has provided, and that checkbook is from your IRA and it is from the custodial IRA account, I don't see any problem with that. I don't see why that would be disallowed if the custodian has explicitly allowed that.
If you make a QCD exceeding your RMD, can you carry over that excess to the next year?
I wish, no, it doesn't work like that,
Okay.
but it does reduce the size of your IRA so that the next year's RMD would theoretically be less than it would have been because the IRA is reduced by the amount of the larger QCD.
Does the order in which you make QCD versus RMD withdrawals impact whether the distribution reduces your taxable income?
I'm so
For
sorry.
example,
Can you read that to me one more time?
if you make the complete RMD before requesting a QCD, does that reduce your taxable income?
No, because if you already took the RMD as a distribution, you can't then QCD out that same money. So it's either or in this case. You have to either request that the RMD go out as a QCD or you request the RMD go to you. You can't request the RMD go to you and then request a QCD. So, but if you already took your RMD and it's not more than 111,000, you can still QCD out more than your RMD up to that 111,000 amount for this year, if you want, right? If you say, well, I was going to give the money to charity anyways, but I know that this is a better way because I'm not getting a deduction for it, the QCD still makes sense, but it's not going to help you with the RMD if you already took the RMD.
Okay. Got a comment here that we should mention to everybody that Arlington Neighborhood Village is eligible to receive QCDs. So,
501c3. Perfect.
yep. Got a couple of questions here, people who would like to have follow-up consultations with you. So if you could put your contact information in the chat or give us a phone
Sure.
number or something that people could
Yeah,
call.
I can do that. I'll put in my email address and my phone number here.
Okay, next question is who or what organizations handle donor advised funds? You'd mentioned Schwab and Fidelity. Who else?
Yeah, so they're the ones that we work with are Schwab, Fidelity, and a company called Greater Horizons. There are a number of private companies that offer donor advised funds. My recommendation is to go through whatever brokerage firm you're using. If you're with Merrill Lynch, they would have some, donor advised fund that they're connected with. It's a lot easier if the donor advised fund that you're using is somehow connected to your brokerage because you can also, it's not just cash that can go into a donor advised fund. You can also gift things. Like some donor advised funds will accept property. Some donor advised funds will accept your mutual funds. They will accept like low basis stock, for example. You want to gift something into a donor advised fund and not pay capital gains on it and get a tax deduction for that contribution. That's a win-win on both sides. So, but it's a lot easier to facilitate that if you're working with a donor advised fund that is already aligned with wherever you have your brokerage accounts or your IRAs, et cetera. Maybe not IRAs, but brokerage accounts.
Okay. Next question is one difference from a tax perspective that a QCD is excluded from your income, but a donor advised fund is actually deducted or subtracted from your income?
Exactly. Again, because it's a donation to charity, the way that a donor advised fund would be a deduction on your income is if you are itemizing, right? Or if that gift is enough to get you over that itemized number, right? That number above the standard. But yes, the donor advised fund contribution is a deduction from your income, whereas the QCD is just a reduction, right? Of what, in the case of somebody who's taking an RMD. If you would have otherwise had to pay tax on your RMD and a portion of that goes out as a qualified charitable distribution, only the remaining amount that did not go out by a QCD directly is taxable to you.
Do custodians sometimes make out the check and send it to you to deliver to the charity?
Yeah, I've had that. Yes, I've had that before where we can, instead of sending it directly to charity, send it to you so you can deliver it yourself.
Okay, we got a comment here. Charles Schwab Investments provides checks linked to the traditional IRA, and the checks say traditional IRA above the signature line.
Okay. So they don't allow us as RIAs to do that, to have a checkbook on your IRA, but perhaps on the private side, they would allow that. Again, just not something that I'm familiar with, but I'm sure it's not a problem.
Are there times when donating an appreciated security from a taxable account may be more tax efficient than making a QCD?
There are times, it is rarer now with the higher standard, but it's just something you need to run sort of a tax analysis on. Your CPA should be able to help you with that and just say, okay, this would result in this net tax savings, and this one would result in this net tax saving, especially if it's a very low basis security. And you wanted to donate that directly to a charity or to a donor advised fund, for example, and save on the capital gains. It just that's a real math question. And it's very specific to exactly how much you're gifting and how much the capital gains are on that appreciated security. But it's definitely possible.
Okay.
Sorry. Maybe I typed my email wrong. I'll try one more time.
Much better.
Sorry.
All right.
Trying to type,
So,
trying to type and talk.
yeah, if anybody else has any additional questions.
I have a quick question. Um, I think, Isabel, you mentioned that deadlines were getting earlier and earlier. Are these custodians that set deadlines for QCD requests? And so it's specific to the custodian?
Yeah. Yeah. So, years ago when nobody was doing QCDs, I mean, it was just new and it was every year. It was like, is it going to happen or not? We could request QCDs up until December like 30th or whatever the last, business day of the year was. I have found that if I start requesting through Schwab a QCD after about the first week in December, they come back to me and say it's best efforts. And that always creates a lot of stress and anxiety for me. So I just like to say, let's not get ourselves into that sort of trouble where we don't know for sure we're going to be able to get it out, because especially if it's an RMD, you get hit with penalties if you don't get it out before the end of the year. So we don't want to kind of push the envelope there. And I know it's hard maybe to make the decision early, but if at all possible, getting it done before December just gives you a little bit more runway. Make sure
So
it gets done.
that's check cashed by the charity by the end of the year.
No. So the check does not have to be cashed by the charity. It just has to be distributed out right before the end of the year. So as long as that's done before December 31, you're good to go. The charity, I mean, even if the charity doesn't cash it until the end of January or later, that's still okay as long as it's left the IRA. And even if, like, let's say the charity loses the check or something happens, we can fix that. It doesn't mean that all of a sudden your RMD is now not completed, right? So that happens and it's okay. It's not great, but it's happened and we've gotten through that in the past.
Okay, thank you.
Can you talk a little bit about what, if any, costs are related to executing a QCD?
On my end, there are no costs to executing that QCD unless you're requesting like an overnight check or something where it's a rush and it may be, an extra $25 for UPS or something. Some custodians may charge a check fee. That would be, I guess, custodian by custodian specific.
Do you know
But
if,
minimal. I mean, if it was anything, it would just be a minimal fee for an additional check or something along those lines.
do you know if Schwab and Fidelity charge check fees?
Not for us. When I execute them, there's no fee unless, again, it's an overnight request.
Okay. So I think we've hit all the questions that have been asked so far.
As someone listening in on this call, I'm super impressed with how smart all of the people on this call are with respect to the questions that they're asking. I'm a newbie to all of this. I'm just turning 73 this year. So, absorbing all of the RMD and IRMA and QCD, it's like I'd have to listen to this 12 times before I got it. But on the other hand, questions coming from the audience, they really understand the system. And Isabel, your advice and comment, not advice, let me just say comment on questions has been informative, on both sides. And also I just mentioned as Arlington Neighborhood Village, there are probably 2 or 3 people who have checks that are actually drawn from their IRAs. It's rare that we see it, but it does exist. Mostly it's coming from the new word I now know, custodians.
Custodian, right.
I'll raise my hand. This is Joanne Jones again. One other thing about 1099Rs. At one point, I wasn't sent a 1099-R from an IRA that was taxable when I had given all the money to charity. This year, I asked them to please send me a 1099-R. Well, it doesn't, as you say, mention that it was a QCD donation. So I'm just hoping the IRS, when they get the 1099-R, will not freak out. But should I be insisting on a 1099-R for those QCDs or not?
Well, yeah. I mean, well, the 1099-R and the QCD are not really related. The 1099-R just says, here's how much you took out of that retirement account, in total, and how much taxes were paid if you had them withheld. The QCD has a net effect of reducing what the amount of that 1099-R should show, but it doesn't, because it's just not aligned, right? The IRS they haven't gotten to that point where they've said the QCD is going to be some separate tax form or whatever. So it's self-reporting, where you're saying, okay, of this 1099-R amount, XYZ was QCD. And I think there's even a box on the tax return that says, was any of this a direct donation to charity? And then you're recording it that way. So you're actually recording it on your tax forms versus using the 1099. But absolutely, if you have money coming out of a retirement account, you need a 1099-R to report that.
Thank you. I didn't check my tax return, but I hope somebody that prepared it caught that, but I'll double check then.
You should definitely double check, so that because you may need to refile if it wasn't recorded properly. It's not a big deal to refile. It's just, but you do want to make sure that you're not paying tax on something that ended up going directly to charity.
Oh, no. Thank you.
Yeah.
We've got somebody said a good book on this topic is The Tax Smart Donor by Phil DeMuth. And I was going to follow up on that. Do you have other resources, books, websites, webinars, anything like that we could take advantage of?
Our website has a ton of information on this, edelmanfinancialengines.com. There's a lot of information about tax smart strategies, estate planning strategies, legacy planning strategies. So I would say that our website is really a great resource. There's lots of articles. There's lots of just one pagers. But if you need more in depth, and it is something that you're feeling a little lost around, talk to a financial planner. Reach out to somebody that can give you some advice about it, and maybe help you to facilitate it, or help you to understand, or an accountant, to try to understand what's the best strategy for you. I do think that if you're feeling out of your depth, get help, right? There's lots of professionals out there who can help advise you one way or another on QCDs, or maybe other things that, we're not talking about today, but that are other really important things to think about. I mentioned IRMA a lot. IRMA is a big deal. Income related Medicare monthly adjustment amount for Medicare. that can be a difference of thousands of dollars a year for people if they accidentally, fall into an IRMA bracket, go $1 over one bracket to the next. So there's things like that, working with a financial planner over time can really help to ease some of those risks.
Isabel, can you give a little bit of your, not so much background, but what your business is? I mean, you've talked about financial planners and tax accountants and this, that, and the, what are you in that scheme of things?
So I'm a financial planner. So what I consider that to be, how I describe that is just the where are you now, where are you going, and how are you going to get there? So I sit with clients and talk to them on a day-to-day basis about, what's your current situation? What are the goals and things that you are trying to accomplish, and how do we help facilitate that? And then the underlying objective of the company is to invest in a way that aligns with that financial planning. So to help, number one, come up with a strategy for your life plans, things you want to do with your money. And then number two, to help manage your investments and cash and anything with a dollar sign attached to it that should align with all of those goals and plans. It's the simplest way I can do it.
Part of that financial planning includes these tax strategies that we've
Tax
been talking
strategies
about.
are definitely included, estate planning strategies, insurance planning, long-term care planning. All of that falls under the category of financial planning.
Mhm. Thank you.
Well, it's about 2 minutes to 11. So if anybody's got any last minute burning questions, now's the time.
I have a comment. Isabel is my financial planner, and she has helped me by doing projections, sort of when will I run out of money if I enter a retirement home based on their monthly fees. And that's been a very useful exercise to have.
Yeah. Hi, Connie. Good to see you.
Alice, do you want to unmute yourself and ask a question?
I have a comment. Isabel is also my financial planner, and she's done a great job with all types of questions that are finance related.
Good morning, Elise.
Morning, Isabel.
Sounds like you've got quite a fan club here, Isabel.
I didn't have all my windows open, so I didn't realize you were all on there, but it's good to see you both this morning. Good to see you all.
A question here. What is fee service? I'm not sure what that question means.
Does it mean what is the fee for the service or yes, okay.
Yes.
So we are what's called a fee-based advisor. So the fee that we charge our clients is based on the assets they have invested with us. So I usually just describe that as it's a sliding scale. It depends on how much money your family has invested with us. But it starts at 1.75% for amounts $400,000 or less, and then there's a tier system above that. But if you wanted to reach out to me, if you were interested in looking into something like this in more depth, I'd be happy to give you a more specific number based on your specific situation.
I'd like to add a comment that there is the family fee, familial fee is lower if relatives also have investments with Edelman Financial Engines, as in my case.
That's correct. Yep. We aggregate everybody in your household and your family together for a fee reduction.
So it's a definite benefit.
All right. Well, it's 11 o'clock. I think I echo what Wendy said. This has been very interesting and informative. I think a lot of people already have experience with this, but there are a lot of us that are approaching these age categories where we gotta start thinking about these things.
Yeah.
You know, sounds like it's never too early to start planning this out.
Nope. Yep.
Never too early.
Well, for me, turning 73, once they said, and I also have 6 months into 74, I said, oh, right.
I want to thank you for taking the detailed question. I'm sorry to do it to you, but it was very helpful.
Great. No problem.
Thank you, Isabel.
Absolutely. Thank you all for having me. I
Thank
appreciate the
you.
time, and everybody have a great day.
Yeah.